Hello, everyone, and welcome to today's webinar, our Global FX Outlook for May 2024. Really appreciate everyone coming along today. It's been a very interesting start to the new quarter. We'll go over that in a minute. We'll let everyone join. We'll give it another minute or so, and then we'll kick off. Thank you. Okay, it's a couple of minutes past the hour, so we'll kick off. Again, thank you all for coming along to the May Global FX Outlook webinar. Of course, this webinar is part of the Global FX Outlook report we publish in the first few days of each month, and that provides our review of the last month, our forecasts for the major economic drivers in the next month, and our FX forecast for a whole range of currency pairs. And really grateful for your time today. My name's Stephen Dooley. I'm the host for today. I'm the head of market insights, and I'm here with Shirley Lim, our FX and macro strategists for APAC out of Singapore. So thank you all for coming along today. The webinar will be around about half an hour or so. And like I said, we'll do a review of April, a look ahead to May, and then we will focus on the FX forecasts, what we're looking for the balance of the year, and then think about some ways that you can apply this information to your businesses. Well, thinking about April, it was really a case that we saw a sharp pickup in volatility. The first part of this year had really been characterized by extremely low volatility, not just in FX markets, but globally right around the world. The reason why volatility had fallen is that markets were feeling very positive. There was an expectation that we'd get interest rate cuts from major central banks, including the Federal Reserve, and that positivity flowed through into a very low volatility market. The VIX for the period averaged just under 15. Anything below 15 is normally seen as a very low volatility market, and in fact hadn't moved above 20 since around October last year. So it'd been a real period up of quiet in financial markets as a result of these hopes for interest rate cuts. But April really saw a big comeback. Like I said, the VIX moved above 20 for the first time since October last year, and clearly a sign that markets had turned more nervous, more concerned about the future. The major trigger for that move higher in volatility was, of course, that escalation of tensions in the Middle East, as we saw a tit-for-tat volley of rockets between Israel and Iran. But the other factor from an economic front was a third consecutive hot inflation number from the US that really made markets think that perhaps there's a chance that we won't get any rate cuts from the Federal Reserve in 2024. That pushed the US dollar to 6-month highs. It pushed equity markets lower. And like we said, right throughout FX markets, what it did was drive a big pickup in volatility. So if it feels like FX markets moved a lot more in April, that's because they did. Like we said, the US dollar was really the outperformer because as markets believed there was less chance of rate cuts from the Federal Reserve, Bond yields pushed higher, and that supported the US dollar as the US dollar climbed higher. And like I said, at 6-month highs, but more importantly, only around 5% away from 20-year highs. So the US dollar really is strong, particularly in Asia, and we'll touch on that in a little bit more. With the US dollar stronger, as markets started to believe that maybe the Fed wouldn't cut rates, the euro was one of the real weaker currencies in April, because money markets now believe that the European Central Bank might be the next major central bank to cut rates. Remember, so far this year, in terms of major central banks, we've seen the Swiss National Bank cut interest rates, but most other major central banks have remained on hold. But markets believe the European Central Bank might be next. The European Central Bank itself said that the conditions are right, and inflation in the Eurozone is currently just above 2%, around 2.5%, which is close to that 2% target that the ECB has. So that's why the euro's been weaker. We've seen that right throughout markets. The euro hit around a 6-month low versus the US dollar, around a 4-month low versus the Australian dollar. The British pound was really quite weak in April. It broke below this trading range that the British pound US dollar had been in for all of this year, between 125 and 129. And again, it was that strong inflation number. Remember, we had 3 hot inflation numbers. The first came out in February, the second came out in March, the third came out in April, and it was really 3 strikes and you're out in terms of Fed rate cut expectations. That pushed the pound sharply lower and managed to recover somewhat, but more broadly, the pound has been weaker for most of April. One market really bucked the trend, and that was the Australian dollar. The Australian dollar got up to a 4-month high versus the US dollar, admittedly at the start of May, but that was after a hotter than expected inflation number from Australia. In particular, the core number that we look at in Australia, the trimmed mean, at 4%. The market had expected it to be around about 3.8. So that was a big enough miss to really push the Australian dollar higher. And again, it was another sign around the world that inflation hasn't come down as quickly as we expected. In some economies, for example, we mentioned in the Eurozone, it is coming down quickly, but in other economies like the US and like Australia, it is taking some time for inflation to slow, and that's what's driving this volatility across FX markets. So let's drill down and look at some of the key points that we're focused on as we move into April. And of course, the first, as we already mentioned, inflation has remained sticky. And in fact, if you look at the global inflation impulse, it has turned more positive. Remember, we had that explosion of inflation in 2020, 2021, and 2022. And then it started to ease back lower. There was still a lot of inflation around, but the pulse had started to slow down. Remember, in the US, for example, in the middle of 2022, inflation peaked out at 9.1%. Inflation has still been very hot, but it's been calming down. And that's what we're talking about here with this move lower. However, you can see that while it had been coming down over the last couple of months, has started to pick up again. The inflation pulse is back positive. Partly supply chain issues, partly commodity prices. Of course, oil prices have lifted as well. And that's what's really been the driver of these inflationary worries. In the US, fears that inflation is stuck around 3.5%. And that means the Fed has less room to cut rates. So clearly, that's the big theme. And as it comes down to what's going to be the most important events in May, well, nothing is going to be more important than next week's inflation reading from the US. If we get another hot inflation reading, then that could really push the US dollar higher, and it can really almost eliminate the chance of rate cuts from the Federal Reserve. That would see the equity market lower, it would see bond yields sharply higher, and it would see risk-sensitive currencies like the Chinese yuan, like the Australian dollar, to weaken substantially. So that higher inflation pulse that we've seen, the main impact that has, and you can see in terms of the actual inflation number, it hasn't had a huge impact. We said for a while inflation's been stuck around 3.5%, but it's had a big impact on bond yields, and you can see they're really pushed back higher. The US 10-year bond yield back near 5%, and that's been what's driven, again, volatility. It's what's caused equity markets to move lower, and it's what's caused the US dollar to remain higher. So, like I said, it's not the necessarily increase in the raw inflation number. It's the fact that it's just been flatlining. The move lower we saw between 2022, remember when we said inflation topped out at 9.1%, came down to 3% towards the sort of near the end of 2023. Markets were very excited when they looked to see how quickly it had fallen, but it didn't keep falling. It flatlined, and that's the problem we've got here. Stagnating inflation enough to pull US bond yields higher. Higher bond yields typically aren't good for the global economy, aren't good for equity markets, and like I said, aren't good for currencies like the Australian dollar and most of the currencies around Asia. So that's why we say that Asia has a dollar problem, and only the Fed can solve this. That's been the other big theme that we saw in April and continues to be the big theme as we go into May, that the US dollar is strongly higher, but it's particularly strongly higher in Asia. And of course, last month we saw a joint communique between the US, Japan, South Korea, talking about the pressure that a strong US dollar is causing to those currencies and to those economies. That was followed, of course, by probably the biggest story in FX markets in April, that intervention from the Bank of Japan, driven by the Ministry of Finance, that went into the US dollar Japanese yen pair when it got up to 160, the highest level since 1990. We saw two major intervention periods last week. Monday, during a Japanese public holiday, after the dollar yen moved to 160, a big move lower, and then a second move to push the dollar yen lower after the US Federal Reserve decision early Thursday morning in Asia. So the strong US dollar is causing problems again globally. The famous saying from John Connolly, the Treasury Secretary to Richard Nixon in 1971, it's our currency, but it's your problem. And again, the US dollar is a problem in Asia, and only the Fed can solve it by cutting interest rates. So that high inflation number that we talked about earlier, stuck around 3.5%, is just creating a problem that only the Fed can solve. So that's going to remain to be a concern. And like we saw with that intervention from the Japanese authorities, that can continue to cause problem in economies and can continue to cause unexpected moves and unexpected shocks in FX markets. So as we look ahead to the month ahead, I've already previewed probably what's going to be the biggest event we mentioned on the 15th, US inflation. That's really going to set the tone with it having been stuck around 3.5%. If it is higher, the US dollar can sharply move higher, bond yields can move higher, and equity markets might move lower. So if you're looking for a point of shock during the month, that's the risk event. And certainly you'd have your eyes on that right throughout the week. Other events that we've got an eye on this week or this month: the Bank of England meets on the 9th. That can set up some pound weakness if the Bank of England joins the tone that we got from the European Central Bank that they're moving towards cutting interest rates. In Japan, we've got inflation numbers out on the 24th. If that comes in lower than expected, that can cause the yen to weaken. It could see the dollar yen push up to 160. It's important to note that this move higher in the dollar yen has had a seismic effect right throughout markets. It's causing the dollar CNH to move up to the top of the range. It's causing the dollar Sing to move up to the top of its recent range. It really is one of the most dominant players in the market because as the dollar yen goes up, that causes the US dollar to strengthen, and that drives a move right throughout Asia, and that's what we're seeing in financial markets. So just to wrap up, we mentioned the volatility in markets, but to drill down a little bit more into what's driving the volatility in FX markets, well, it's really about the policy divergence. As we see central banks moving at different paces, that's what's driving the increase in volatility that we saw in April that's carried through into March. Most obviously, the Federal Reserve less likely to cut rates, causing the US dollar to strengthen. The European Central Bank and potentially the Bank of England moving more towards cutting interest rates, causing their currencies to weaken. And in Australia, the hot inflation number, the fact that the Reserve Bank of Australia might need to keep rates higher for longer, causing the Aussie dollar to strengthen as well. So this policy divergence remains really key. In terms of the key event for the month ahead, we already mentioned US inflation, but otherwise, let's just see how the US economy travels. The US economy has been the strongest economy in the developed world for the last 18 months. We're starting to see some cracks. Some of the leading indicators have underperformed. We saw the US jobs number last Friday miss expectation for the first time since the October 2023 result. So we're starting to see cracks. So that's really what we're going to be watching for in the month ahead. How strong is the US economy? How does that translate to the inflation story? And again, that big story that we really continue to focus on, can that continue to keep the US dollar at an extreme elevated level, or will the US dollar start to weaken? Let's drill down a little bit further into that. I'll pass on to Shirley, and Shirley will look at the key events and the key drivers in the APAC FX region. Thanks, Shirley.
Thank you, Stephen.
We can't hear you, Shirley. Just checking to see that everything's right with your sound there.
Can you hear me now?
Yes, we can. Thank you.
All good. So now let's look at the APAC value indicator slide. Let's look at where some of these APAC currencies are trading relative to historical averages. As this table shows, the Australian dollar is really standing out as an outperformer, particularly against the Japanese yen. The Aussie-Japanese yen rate is currently more than 22% above its 5-year average level, with the BOJ being the only major central bank holding off on policy normalization so far. The yen has substantially underperformed. Against the New Zealand dollar, the Aussie is trading just over 2% above its 5-year average, indicating the two currencies are fairly well balanced against each other based on longer-term valuations. When we look at Aussie dollar's performance versus the euro, Sing dollar, and British pound, we see it's currently trading at a modest discount of 2 to 6% compared with its 5-year averages against those currencies. But the most noticeable value play is in Aussie US dollar. The Australian dollar is sitting around 6% below its 5-year average against the US dollar. So valuations suggest some decent upside potential there if economic conditions cooperate. Speaking of the Australian dollar versus the US dollar, let's walk through some potential future scenarios for this major exchange rate. On the downside, ongoing financial system stress emanating from China's troubled real estate sector could be a significant headwind. A bigger shock in that area will likely weigh heavily on the Australian dollar. In our central scenario projection, we do see Australian dollar regaining some ground versus the US dollar. The key factor here is RBA's reluctance to follow other central banks like the Fed into a cycle of outright rate cuts just yet. While the RBA may keep policy steady at coming meetings, Fed rates are expected to remain comfortably above RBA rates. So the yield differential should cap top upside for the Aussie dollar near term. On the upside scenario, sustained upside inflation surprises in Australia could force the RBA's hand. If they are compelled to raise rates or hold them higher for longer, the policy divergence could provide a decent tailwind for Aussie dollar upside. Now over to our friends across the Tasman Sea. On the downside, watch for potential housing market fallout in New Zealand. If rising costs and rates exacerbate declines in consumption or push up unemployment more than expected, it could threaten the nation's financial stability. That will likely spur more aggressive rate cuts from RBNZ, weighing on the Kiwi dollar. The central scenario appears more balanced, while the New Zealand dollar remains susceptible to any negative risk events that spur investor risk aversion. It could find some support in China's economic recovery exceeds expectation. A lot will also depend on export prices for key New Zealand commodity exports. On the upside, the new government has hinted at potential tax cuts and deregulation down the road. If this pro-growth agenda gains traction, it could boost local asset returns and attract investor inflows, buoying the New Zealand dollar. Turning our attention now to the Chinese yuan. On the downside scenario for USD CNY, we have to consider the potential for larger than expected stimulus from PBOC as they aim to reinvigorate economic growth. While aggressive easing is unlikely to trigger disorderly yuan declines, it could prompt a controlled depreciation of the currency against the US dollar over time. In our central scenario projection, we could actually see the yuan firm up moderately versus the dollar. Beijing has recently implemented supportive policies to boost the domestic economy, suggesting they want to encourage a certain degree of currency strength. The Fed's own dovish pivot on rates could also take some pressure off the yuan if US rate cuts materialize as expected. However, don't rule out renewed yuan weakness in the upside scenario for US dollars CNY. Despite PBOC's easing efforts so far, if housing markets prove protracted with spillover effects from the broader economy, persistent economic worries could put depreciation pressure back to the yuan versus the US dollar. Now let's shift over to the Sing dollar next. On the downside for US dollar Sing, we have to consider the possibility that the Fed may be forced to cut interest rates more aggressively than currently expected if the US economy loses steam. Aggressive Fed easing will likely undermine US dollar across the board, including against the Sing dollar. Our central scenario calls for range-bound directionless trading in US Sing for a period of time. As this chart shows, the Sing dollar has remained well above its trading range over the past year, despite shifting global growth narratives. With economic prospects appearing balanced for now, the US Sing rate seems to be consolidating within its recent ranges. On the upside scenario, the biggest risk may come from potential broad risk-off move hitting markets. If we do see a sell-off in risk assets like equities and commodities, it could spur safe haven flows into the US dollar, lifting US Sing as investors reduce exposure to the trade-sensitive Sing dollar. Finally, let's discuss the wild child of the major currency markets, the US dollar yen exchange rate. On the downside for USD yen, the scenario where Fed is forced into a series of quick rate cuts could relieve some upward pressure on the US dollar. That will certainly weigh on US dollar yen as the interest rate advantage over Japanese yen gets pared back. Another potential downside risk, if we do see a major sell-off or volatility shock in the global financial markets, USD yuan is often a focus for speculative carry trades that prefer calmer, low vol conditions. So deteriorating market sentiment could hit this exchange rate. The central scenario, however, is more aligned to the Fed bringing down inflation in a controlled manner without necessarily cutting rates aggressively. In that environment, USD yen could remain elevated as the Bank of Japan only gradually normalizes policy from its extremely accommodative stance, and the policy divergence keeps favoring yen weakness for now. The USD yen upside scenario is where US inflation proves even stickier than expected. If that forces the Fed to keep hiking and hold interest rates higher for longer, widening that yield differential versus Japan, we could see USD yen being propelled even higher from current levels. Additionally, if Japanese inflation remains relatively subdued compared to other nations, climbing back towards the target levels, that could add an extra tailwind for yen weakness against the US dollar and other major currencies. So in summary, while the yen's power will be heavily influenced by the Fed's actions, the balance of risk does seem tilted toward further yen depreciation, given the BOJ's sluggish removal of monetary accommodation relative to peers. Thanks.
Thanks, Shirley. Great update there, and particularly the dollar yen, like you said, the wild child in FX markets at the moment. I'm going to look at some of the key pairs in the North American market. And of course, like we already mentioned, the US dollar just dominating financial markets at the moment. 22-year highs versus Asia, 7 or 5% off 20-year highs more globally. And of course, the market that's seen the biggest gains has been in the Japanese yen. Look at this, 8% above its 1-year average, an incredible 30% above its 5-year average, really outperforming here. The US dollar's also seen a recent rally versus the Mexican peso. The US dollar, as interest rates have gone up, has done particularly well versus emerging market FX. That's part of what's boosting it in Asia. It's been a bit of a flip though, really, because of course over the 2-year and the 5-year average, the US dollar still well below the historical average for dollar peso. Really, the Mexico's industrial base are really driving quite a sustained period of strength for the peso over the last 2 and 5 years. Otherwise, the dollar remains elevated versus the Canadian dollar. You can see the US dollar is above its long-term average on year-to-date, 1 year, 2-year, and 5 years. So the US dollar doing strongly. That said, the gains versus the Canadian dollar aren't quite as strong as we've seen in a lot of other markets. The CAD has been supported by the relentlessly strong oil price that we've seen that's been really well supported ever since those tensions in the Middle East escalated in October last year. In other markets, you can see here these currencies that are really underperforming versus historical averages versus the US dollar. The Aussie dollar, for example, 6% below its 5-year average. The pound, around 3% below its historical average. The euro around 4% below its long-term 5-year historical average, and the Kiwi really at the bottom of the table, 9% below its long-term average. The Kiwi really underperforming, of course, because it is historically closely tied to the relative difference between interest rates, and as those bond yields in the US pushed higher, the Kiwi has underperformed. So US dollar strength across the board really continues to be the theme. More broadly, this might continue in the near term because, of course, the US dollar is supported by these higher bond yields and the fact that markets believe the Federal Reserve is unlikely to suddenly change course and cut interest rates. So for now, you can see in the British pound versus the US dollar expected to remain broadly near current levels in the central scenario. Of course, FX markets are volatile, and so there are the opportunity as that volatility plays out to be able to try and take advantage. Pound buyers should be looking for a move back down to 123. Pound sellers should be looking for a move up to 127, 128 over the course of this year. But for now, the pound might be underwhelming. Similar on the euro, as expectations grow, the European Central Bank will cut interest rates, and the Fed might be on hold in the near term. That can see the pound weaken, potentially the lower end of the range around that 105 level. But for now, the central scenario, as you can see, the dollar strength prevails, and we see the euro US dollar trading around that 105 to 109 level. So a similar story like we were saying on the pound. Your euro sellers looking for a move up to around 109. Your euro buyers are looking for a move down to 105. Finally, looking at the dollar CAD, this is a market like many other markets that have seen a upward revision to expectations as the US dollar remains strong and expectations grow that the Fed won't be able to cut rates by the speed that was expected at the start of this year. So again, 135 seen as the central scenario over the course of the year. Again, the trading range around 133 to the downside, 137 to the top side. US dollar buyers looking for a move down to around 133. US dollar sellers looking for a move up to 137. Again, like in all of these moves, these are the central scenarios, and a change in outlook can drive big moves in FX markets. And if the Bank of Canada looks to cut, then that opens up the risk of a move higher up to around 138. But on the other side, the risk to the downside, they can see a move down to 129 or substantially lower is if we start to see some US labour market weakness. And like we mentioned earlier, we have started to see that start to creep in after the April jobs report missed expectations for the first time since the October report in 2023. So what does this FX market movement mean for your business? Well, certainly think with the pickup in volatility that we've seen in April, that suggests that material 5 to 10% shifts in key exchange rates can really impact the market and impact what your expectations or achievable target rates are. So again, volatility might be set to continue. This divergence in central bank moves, the potential for geopolitical stress, the likely impact of the US presidential election means over the next 6 months, a pickup in volatility might be likely. So that's certainly what we're looking for. Geopolitics, we already mentioned the impact that can have. We saw earlier how stresses in supply chains are starting to come back and driving higher inflation impacts. That's particularly what we've seen through the Middle East over the last 6 months. So again, this opens up about why businesses are increasingly looking to diversify supply chains. And of course, geopolitics ties into sanctions. And we've seen a massive increase in the number of sanctions and complexity over the last 2 or 3 years. And again, that's something that we can help you with as well. So this FX market movement, it has a real world impact on volatility, on geopolitics, and on the sanctions outline, sanctions regime. And that's really what we're looking to do to help with you. So I wanted to finish up here. Don't forget the survey here. We'd love to get your feedback about what you think of the presentation, what you'd like to see more of. And so please, if you do have the time, get your phone out, take note, or take a photo of the QR code, and that will take you to the survey. We really appreciate your feedback. We send a recording over the next 24 hours to attendees and those that are registered via email. But on behalf of everyone here at Convera, I'd like to really thank you for taking the time. Hope you found this session useful and look forward to speaking to you soon. Thank you, everyone. Thank you. Bye.